What do you get when more than one person goes into business together and no tax elections are made? A partnership. This week, in part 2 of 4 of our business entity series, how do partnerships work? A partnership exists when 2 or more people or entities run a business together. The partnership itself doesn't pay income tax. Instead, income and loss pass through to the owners, and each partner pays tax on their share through their own individual tax return. The partnership files Form 1065. That's the annual partnership information return, and that's due on March 15th. It doesn't result in a tax payment from the partnership, but it does produce Schedules K1 for each partner. Those K1s show each partner's share of income, deductions, and credits, and that information flows into each partner's personal tax return. If you've ever filed an extension because you were waiting on a K1, now you know why. Partnerships are a very common source of late K1. In a general partnership, every partner is personally liable for business debts, and each general partner's share of business income is subject to self-employment tax. A limited partnership has a different setup. General partners manage the business and carry the liability, while limited partners are typically passive investors, and their share generally isn't subject to self-employment tax. The other important thing to note, a multi-member LLC is taxed as a partnership by default, unless the owners make a different election. A lot of people think LLC is a tax classification. It's not, it's a legal structure. The tax treatment depends on an election, and most multi-member LLCs never make one, so they land in partnership territory automatically. Whether you're a multi-member LLC or just 2 people who decided to go into business together less formally, partnerships are a common entity type for businesses. And that's partnership taxation. Hit like if this cleared up how partnership taxes work, and check back next week to learn about S corporations.